and gentlemen, I'm Hiral Dadia. We have with us Dr. Rupa Rege Nitsure, Group Chief Economist at L&T Financial Holdings, joining in. Welcome to the show, Rupa, and always a pleasure to speak to you and get insights from you. Rupa, overall, if you see in terms of where economies are concerned, clearly inflation has been a concern globally. You have central banks who are coming and looking at tightening as well and squeezing out liquidity. What's the sense that you pick up now with the latest data that is coming in? Because in terms of India as well, you have the August inflation and the July IIP data, which is due.
Growth inflation has improved for India. There is no doubt about it. And as we had discussed in this show earlier also, India has one advantage, that its total consumption and investment, domestic consumption and investment comprises almost, 80-85% of its GDP. So that way, we don't get very significantly impacted by external negative events in the external world. And luckily, this year monsoon has been good, even though in the northeast and northwest there are some rain deficit regions. Like major states like Uttar Pradesh, Bihar. But barring these two states, rest of the India has received bountiful of monsoon. Water reservoir levels have been very good. Farmers are getting better crop realizations on last year's Rabi crops. Terms of trade have become favorable for farmers. New export markets have opened up for Indian agriculturists because of this ongoing Russia-Ukraine war and problems in China because of trade restrictions, and because our neighboring countries are not doing well. Indian agricultural exports are gaining more of market share. So I feel that the real growth driver this time will be rural India. Unlike the earlier two seasons, when we had seen, since the second wave of COVID, we had seen that rural India was impacted very badly. But this time I'm seeing a lot of optimism in rural Indias and rural belts.
Right. So overall, Rupa, if you see in terms of the first quarter GDP, we came in at around 13.5%, and Bloomberg consensus was showing you somewhere around 15.3%. Clearly, what is your view of this number that has come in, and how would you actually retain in terms of FY23 growth forecast?
See, I don't attach much credence to these GDP numbers because it is too aggregative, and we know that because of the pandemic, data collection efforts are also very badly impacted. So, like during the pandemic, the losses incurred by unorganized sector were not actually accounted for. Now, the gains made by unorganized sector are also not being accounted for. So I will go by various leading indicators for various sectors. Of course, the GDP data itself is not very rosy because if you compare it with pre-pandemic level, then yes, the growth is just 3.5%, which is not very high. But if you see the growth of retail businesses and retail sales with the pre-pandemic level, then it is 18-19%, which is very high. So personally, I feel that a lot of growth momentum now we are seeing in retail side, in MSME side, rural side, which augurs very well for overall growth of Indian economy. So whether the final number is 6% or 7%, that will not make much of a difference. But what is driving that really matters. And now the positive thing is that in rural belts, unemployment has started declining, because earlier, the demand under Manrega was very high. But as this year, agriculture has started doing better, and there are bountiful of water reservoir levels, we are seeing less demand for jobs under Manrega, because a lot of rural laborers, they are getting employed in sowing operations, core agricultural activities, and that is getting reflected in upsurge in rural consumption demand.
Right. And overall, in terms of where the inflation goes, what's your estimation with the current number that is expected to come in terms of CPI and WPI and the IIP that will come in?
See, I'm a bit conservative always. So I feel CPI inflation will be again close to 7%. My
Mhm.
exact forecast is 7.1%. But that is because of the base effect also. And we have seen, sequentially prices of many cereals, pulses, edible oils,
Mm,
etc. have gone up between July and August. But then, higher commodity price inflation gets translated into tailwind for farmers who had suffered from
mm.
adverse terms of trade for last 2 years. So going ahead, it will get translated into higher agricultural earnings and provide support from rural demand side. That is how I look at it. Otherwise, there are adjustments of kerosene, LPG prices, that impact is also lingering. And we have also started seeing some kind of hardening of home prices, rentals, etc. at the
Mm.
higher end segment. So, but that is again a sign that things are getting normalized.
Right. So that's on the inflation front. Now, coming to in terms of the current account deficit as well, do you see that widening from the previous number that we saw? It was, I think, a deficit of 1.5% of the GDP in the fourth quarter of FY22. What's your anticipation with regards to the first quarter of FY23 and what could impact it?
See, it will definitely for the entire year FY22 also,
Mm,
because India has huge dependence on imports and imported oil, and everything depends on global commodity prices. So now that global commodity prices have slightly eased, we are seeing FPIs again returning to India and long-term interest rates coming down compared to
mm,
short-term interest rates, etc. But nobody knows at this point of time where actually global oil prices will settle.
mhm.
So when Indian economy is in a growth mode, our imports also grow exponentially, and that puts stresses on our trade account. So when trade deficit widens, naturally that becomes the primary driver of current account deficit also. But then, because India is relatively doing better now, and because FPIs have started returning, let us see, there may not be a very huge concern on financing of current account deficit. And Reserve Bank of India, of course, has done an excellent job in creating good buffers and interventions. So they will certainly prevent excessive volatility in the currency market. There is no denying of the fact that rupee is under pressure, and it will depreciate further. But its actual pace of depreciation will be driven by one, global crude oil prices, and secondly, the pace at which US Federal Reserve tightens the monetary policy going
Right.
forward.
And with all of this said and done, how do you think will a US recession impact India? Because clearly shallow. And if that is the case, how big an impact are we expecting? And do you think, we are insulated, or do you think we're not at all insulated?
Where we are somewhere in between. Definitely, India's exports growth will come down if there is a recession in
Mm,
US or Europe or China. China is also slowing down, and India has very strong trade linkages both from the exports and import side to
mm,
China also. But what I'm saying is that there are certain product groups in our export baskets for which there is inelastic demand, and they are primarily agricultural commodities like cereals or spices, processed foods, juices, floriculture, etc. So, and if you see last 2 years experience, the demand, the external demand for these products, even during pandemic, was very good. Now also they are growing. So exports as a whole may not do that well, but there are certain pockets of value and excellence where things may look better. But US recession definitely has a silver lining for India, because if US gets into any serious recession, that will impact global oil prices. And if crude oil prices fall, that will have more beneficial impact on India than the negative impact of US recession. That's what I feel.
Right. And with India, recently surpassing UK in terms of growth, what's your read?
No, I don't attach much credence to
Mm,
this kind of ranking, because the point is that we all know that UK is in a very bad shape, both economically, politically,
mm,
and this purchasing power parity concept, it doesn't make sense. Actually, rupee, no, Indian rupee, if you see, it was most of the times in our history, rupee has always stayed overvalued, and a correction happens in rupees value only during such crisis period, because Indian inflation structurally is always higher than inflation in its trading partners. So I feel this correction in rupee actually is beneficial, in the sense that it will correct that overvaluation, and it will act as an incentive for our exports also going forward.
mm.
So on in a, if I look at the net balancing effect, I feel a global recession and its impact on global crude oil as well as commodity prices, that will have more beneficial impact on India's growth. Because as I said, we are primarily domestically oriented economy, and our domestic consumption and investment have started gaining traction. So that augurs well for our growth.
Right. And very lastly, now that you brought up the rupee as well, what are the levels according to you that we will see the rupee stabilize? And in turn, how are you even seeing the bond yields?
It is very difficult, because this is the phase of heightened uncertainty. So, means rupee crossing 80 also, people will not be surprised. But
Mm,
5, 6 months ago, we wouldn't have believed. So, as I said, this is a very volatile situation, and going ahead, a lot depends on the movement of crude oil prices and US Treasury yields. So saying whether it will further depreciate by 2% or 4% doesn't have much credibility. But yes, it will have a depreciation bias for sure. Regarding interest rates, I will say that there will be a divergence between short-term rates and long-term rates. All this talk of US getting into recession and global crude oil prices easing, they have actually impacted a longer end of the yield curve favorably. So we
mm.
have seen that in last recent few weeks, actually long-term interest rates or yields have come down. On the other hand, RBI's aggressive tightening is impacting short-term rates adversely. So we are seeing, CP rates, CD rates, bulk deposit rates on a shorter deposits rising very sharply compared to longer term rates. So I feel the way things are evolving, this pattern will become more intense, and we will see growing divergence between India's short-term interest rates and long-term interest rates.
Right. So I think that's a very good holistic picture, Rupa, that you've given us as well. Thank you so much for joining us on the show. It's always a pleasure to speak to you. Thank you. Stay safe and speak to you soon again.
Yeah, thank you very much for giving me this opportunity. It's always a pleasure to participate in this show. Thank you.
Subscribe to our YouTube channel for in depth interviews of India Inc. and press the bell icon so that you do not miss our updates.